Well, looking at Sweden to start with, we see extremely strong growth in Sweden at the moment. We have negative policy rate. Riksbank has a negative policy rate. We have quantitative easings, extremely expansive monetary policy. And at the same time, we have, in fact, an international extremely strong growth. We are expected the GDP growth to be at around 3.5% per year in 2015 and 2016. And looking at this graph, we can see that this is basically in line or better than the global growth during this period. So, and that is unusual for a developed country. It's significantly stronger than the growth in the US and extremely much stronger than the growth in the euro area. So we have strong growth. And in fact, growth forecast for this year and next year has been revised upwards during the last month now due to the migration and the big immigration and the flows we see right now. And this is putting an rather substantial fiscal stimulus to the economy because we basically financed it on the debt side. We increase our government debt to finance the expenses for this heavy inflow of immigrants. So that is pushing up growth in the short term. What will happen in the long term is much more unsecure. That depends on how well we can integrate these people into the labor force and so on. But on the short term, it's definitely a fiscal stimulus. And so 3.5% growth, that's strong. But however, we also see that the stock market is indicating a slowdown in the economy. We see how the stock market is a good leading indicator for GDP growth. The dark blue line is the Swedish equity market, and the light blue line is GDP growth on a quarterly basis. And I mean, we see a global environment and a global slowdown, and that is affecting the Swedish stock market. And we will most likely see slowing growth from 2017 and ahead, as we see. So we see that kind of a global slowdown has already started, and that will affect Sweden and the Swedish economy as well. So we have naturally very strong growth. We have naturally extremely expansive monetary policy and very low interest rates, although, in fact, spreads between the Swedish long-term bond yields and German, for instance, has increased during the recent time. It might be that investors are starting to get a little bit worried about Swedish housing prices, perhaps a little bit worried about the future deficits, but still our government situation and government finances are extremely good, I would say. We have one of the lowest official government debt levels in Europe. However, when looking at GDP growth, it's important to break it down on the regional level. And here, as we just heard from the previous speaker, we can see that the growth in Sweden is extremely concentrated to Stockholm. About 2/3 of GDP growth in Sweden is actually taking place in Stockholm, in the Stockholm region. It's very concentrated. We also see that population growth is strong in Stockholm region. And this is actually figures that's about a quarter old or something. So these needs to be revised upward quite heavily. So I think this immigration flow will generate even stronger urbanization and even stronger population growth in Stockholm. So we have very strong growth here in Stockholm. On the other hand, we have a situation where lots of the inflow is in fact relatively low qualified labor that goes into the unqualified service sector. So it's also important that we can have a political situation and political decisions that can follow up this growth. We can have a functioning residential market and a labor market that so we actually can get these people into work. But strong growth focus on Stockholm, and that is having a large impact on the property market, on the Stockholm property market. And here we also can see that the stock market has a high valuation generally of property. We see the yields are at historically low levels, but when we look at the stock market, the stock is actually valuing property even higher. We can see that we have a equity market premium on the listed property companies that has increased since Q4 2014 from about 20 to 25 to 30%. So we have a large premium on the market. We also see that if you calculate the yield on the listed property companies' properties, basically, you can see that the stock market is trading down that yield from about 5.5% to 4.5%. So, and this is basically two factors. To start with, we have had fast changes in yield levels, and valuations are a little bit behind the curve. So it's actually more accurate valuations of the property market, but also a liquidity premium, of course, because it's lots of people that are interested in exposure to property, and many of these don't have the ability to this exposure outside the listed companies. So this is also a factor. But this is also, I mean, one major factor that drives the market. And at Catella, we've done a number of deals where we actually list, we buy and list property companies, and that's a good potential for that. And we also see high activity, as we heard previously here. We've seen basically that has been a shift on the market during December late 2014, where the market liquidity went from about 100 to 110 billion SEK to about 140 to 150 billion SEK. That's a rather significant trend shift. This level of about 110 billion SEK has been relatively stable since 2010. So between 2010 and the entire 2014, we saw very stable overall volumes. But this was a shift that took place late last year, and it has continued. I think in November, it's the annual rolling 12-month volume is 134 billion. So it's roughly in that interval still. And here we see how we have had a strong pressure downwards in average yield levels on historical transaction. And we also see how spreads on the market, spreads between A, B, and C location has pushed down. This is very correlated to the average yield level. And this has been pushed down also by this strong investor demand. And we also see a very, very thin supply for prime assets. So we see that the market have moved out to suburb locations and more secondary locations, and many transactions are taking place there. So high activity. However, we also see or believe here at Catella that the property cycle has already peaked. And basically, one of the factors that we base this view on is when we look at spread. Actually, we calculate implicit spreads on the market, where we calculate transaction volumes, and we calculate the spreads between A, B, and C locations. And when we calculate this and make it to an implicit standard deviation on the market, we see that this is actually correlating to the VIX index. VIX index on Standard & Poor's 500, which is often called fear gauge, which is a measurement of investor risk willingness, basically. And here we can see that the risk willingness lies about 2 to 3 quarters ahead of the Swedish property market. We can see that during the financial crisis, VIX went skyrocket, and we saw that the implicit yield on the market skyrocketed as well, due to basically mainly that liquidity decreased significantly, but also that spreads between A, B, and C locations spread apart. We see that during the 2 euro crisis, the same thing happened. And here it was mainly, liquidity was rather stable here. It was mainly that spreads actually increased between A, B, and C location during these occasions. And now we're at a situation with historically low spreads. Spreads are very compressed between A, B, and C location. But we also see that in August mainly, we saw lots of volatility on the stock markets due to the stock crash in China. This has gone down again due to expectations of further stimulations, further central bank stimulations. So this is back again, actually below long-term average. However, we think that this volatility may continue. And if it does, if we see elevated levels for a number of weeks or months, we think we will see an effect on spreads on the property market too. And one thing that's interesting is when we look at the same correlation here between credit spread between AAA rated and BAA rated corporate bonds, Moody's indexes for this. we can see that these has actually gone up significantly. We see that the AAA rated bonds have gone down with government bonds, while BAA rated, lower investment grade rated, have actually increased. And we also see that yields on high yield bond markets have increased. So this might be an indication that we see that the market is actually starting to turn, and we see that we expect perhaps to start with the second half of 2016 that the spreads between A, B, and C location will actually spread. However, we see that real interest rates will remain very low for the foreseeable future. Actually, Bank of England had a report released last week, I think, when they expect real interest rates in the West world to be around 0 for the foreseeable future. And we think that's reasonable. And due to this, we think actually that yields on prime assets with potential for rental growth over the economical cycles, we will see extremely low yields. Perhaps yields should be even lower there than they already are. But we think that this yield compression will go apart because it will be harder with financing in secondary locations, and also risk willingness will decline. So we will see that these yields will go apart a little bit and increase in difference. And this is also, I mean, this issue on the credit market is actually something we've seen in Sweden too recently. This is issuance of preference shares in Sweden, which has actually soared since 2010. However, this has actually stopped since summer 2015. Here we can see the issuance during 2015. Lots of issuance during the spring up until the summer. Then we have some issuance that actually failed during the summer. And then almost nothing during the autumn. And it's very hard to issue preference share. It's hard to issue corporate bonds. And this follows very well the trend we see in the US, where it's actually, you could call it a slaughter on the high yield bond market. And actually, during the last weeks, we have experienced that some transactions in B and C locations on the property market is actually taking a little bit longer term. It's not that easy looking at the property market here. And we also see that transaction is perhaps starting, and this is hard because it's also an issue about an Q4 issue, because banks generally have, I mean, full books for by the end of the year, and it's hard to get financing that way. But whether it's just a seasonal pattern or more a trend shift, it's a little bit hard to say. It's very early yet, but I wouldn't be too surprised if it's getting a little bit tougher just looking at what's happening on the financial and the credit markets. So what we see is actually that we are experiencing extremely low prime yields, and we see deals actually done at below 4%, about 3.75% in prime Stockholm. And we think that these yields will remain extremely low for the coming years. We don't see any pressure upwards in real interest rates. We see that we are mainly in what we can see a period of secular stagnation, very low global growth, very low inflation, very low interest rates. And these will remain for the foreseeable future, at least for a 3 to 5 year period. So what we see that these will remain, although when the economic circle turns, of course, it will be an upward pressure, but it will be very little. What we see is that spreads will go apart, and we see the liquidity will decrease a lot in these more secondary locations. And then another issue is that during the last year, lots of transaction has taken place in the prime end of the market has been by institutions. Institutions own about 60% of the CBD office market at the moment. So this is also an issue. Will we see any transactions here? Not there that much, perhaps. We will perhaps see a focus on a good inner city and good prime suburb location, because there is lower ownership of institutions. Instead, what we will see is that we have a very concentrated growth to Stockholm. The Stockholm growth is very concentrated to a few focal points in the region. And here we will see strong rental growth. Although inflation is low, we will see strong growth. And this is the kind of hotspots to focus on for investors. Here we will see good total return. Although yields are extremely low, rental growth is strong. And in this environment with very low interest rates, we will see good return here. Good return, and based on low vacancies, based on strong rental growth. And this is, after all, the matters that create total return over the long term. On the rental level. No, not yet. Not yet.
How far to go?
We started I mean, we're starting to go into the levels that we had in the early 2000s, but a little bit more to go, I think. And of course, that's, I mean, that's in real terms, you have further to go, so to say. Yeah. Sorry? Yeah, I think on capital values we're in historical high because we have low yields. But I think we have an environment that those. I mean, you cannot really compare that because interest rate levels are at an entirely different level now, and will probably remain on an entirely different level for foreseeable future. So, capital values should be higher now than they were 15 years ago. And basically, when we see at the total return development, to start with, we can see total return on the Swedish property market, how well it correlates with GDP growth. We have a correlation for 30 years of about 0.65, which is extremely strong. We also see that falling interest rates have pushed down average total return. We had an average total return of 12%-ish, 12%, 1984 to 2000. It fell to 9%, 2000 to 2014, and now we expect total return to be around 6.5% for 2015 to 19 in average. So we see a push downwards in total return because we press down yields, basically. And yields will remain low. And here we also see that the best performer by far will be the, I mean, really good locations. Good location with strong rental growth. It comes basically to all property segments. What's the segment that differs a little bit is the residential market, because here you can actually have rental growth all over Sweden. We have very evenly distributed rental growth because of the rental regulations. So this is the kind of property property segment that differ a little bit from this. But when it comes to commercial property, it's very focused to the main cities and specifically Stockholm, and a few hubs with good communications, which actually see strong rental growth. And we also see it's a good moment at the moment to sell in more secondary locations, because there we have good liquidity now. We already see it's starting to shake. We don't know if it is because of seasonal patterns or because it's a more general trend, but I think it's good timing to sell these type of properties at the moment.